Hi, my name is Grace Borsellino and I'm a lecturer in law in the School of Law at Western Sydney University. This presentation is about FinTech and its evolution, and it's to give you a little bit of insight into the changing nature of technology with companies in the financial services sector and how that will affect you in the legal profession or the business world, and how the client is looking different, how the business is changing and emerging. So, fintech, put simply, is the marriage of finance and technology. So, it's the combination of finance and technology delivering financial services through technology with the assistance of tech firms. So, the benefit of this, or what that means, that just, when you think about what that means, think about a bank, a big bank, and a tech firm helping that big bank, with the customer, and their experience with the bank. So you might be going through like an app that a tech firm made, and through that tech firm and that app, you're able to connect with your bank and access your banking services more seamlessly with your bank because of that tech business that's now working with your bank to help you get sort of better products and services. And that's just one example, I guess, to put it all into context for those who felt that, who might feel that that's a lot of information to process initially. So what are some benefits of having new technology and working with, sort of a more traditional form of business? It really results in more of a productive and a positive symbiotic relationship between your tech firms, which there are a lot of fintech firms, and traditional financial institutions. So the speed at which technology has evolved, it's led to a much needed partnership and a collaboration between your tech firms and your traditional financial service providers. So despite the disruption that this might cause, this partnership between banks and third-party providers, it has served as an extremely important way forward. And there are a variety of different types of fintech businesses and business services. The example I gave earlier was just one very basic example of the average consumer accessing their bank and their bank products. More examples of where, fintech firms are going is neobanks. So neobanks, they are a type of direct bank, and they're 100% digital, and they reach customers on mobile apps and personal computer platforms. So neobanks operate without a physical branch. So the Fintech Ecosystem, it also includes mobile payment services. And other examples of mobile payment services are Alipay, also known as Alibaba, and WeChat Pay through Tencent. Both Alipay and WeChat in China, they processed more than $10 trillion worth of transactions in 2017 alone, with 502 million users. So it just, the rate at which this is exploding is so quickly. It's at such a fast rate that, regulators are really struggling to keep up with the pace of change in this space. Another really great example is Paytm in India. It has over 200 million users, and it's also acted as a form of, in it being a banking app, and providing access to banking services to a lot of people in India that wouldn't usually have banking services. It's also acted as a form of financial inclusion for these informal economies that would otherwise be unable to have a bank account or get access. A lot of the times, your usual street trader who's just selling maybe, some beans or some, everyday perishable products, they wouldn't be able to afford a bank account. But with, something like Paytm in India, There are so many other things that it offers people using it if they have a mobile. For instance, there's now transactions. It gives them a financial footprint. There's now a way for them to receive payments in a safe manner so that they won't be, sort of less chance of being robbed or someone stealing their money. And it also gives, I would say, people in India that wouldn't traditionally have credit ratings an ability to maybe get some finance for their little business. And there's also another one in India, I think it's Paytm Gold, and that actually, when you get to a certain amount of points, they will send you a gold nugget. There are some people in India that save gold, so you can actually convert it. And, it's just another example of a fintech business really catering to a different group that would otherwise be considered, the unbanked population. So it's given informal economies an ability to access bank services and products. And as I mentioned earlier, the small street traders in India, they can use fintech products like Paytm, and by doing that, they can get the necessary financial footprint for their future financial forecasts and their buying and earning capacities. And certainly with women in these communities, they wouldn't usually have their own personal bank records and so forth. So it also empowers, I guess, closing that financial gap with and empowering more females in those countries to, become more entrepreneurial and have something that empowers them to further progress, as long as they have a mobile phone, unfortunately, for now. So fintech has really changed the way small businesses operate throughout the entire world, and it's really acted as a major vehicle for promoting social inclusion. There are other fintech products that include AI financial advisors. For example, Peffin in America, that's one example that I thought was interesting. It's a financial services firm, so it's like going to a financial advisor, but it's completely, it's all AI. And so they use their platform and their artificial intelligence to help customers make more important financial decisions that are effortless and confident using formulas. And so you're not relying on a person to go in and do all of the comparisons between the products and looking across all of your accounts. You actually have, this AI product to do it. And obviously people that work there will go over and do the final due diligence. But it's a lot cheaper to get what would otherwise be very expensive to get a financial advisor to really consolidate and give you personalised, actionable planning for your investment strategies that would, automatically adapt and grow with you. So that's one other example, Peffin in America, that seems to be doing quite well. In Australia, we have Pocketbook. It's a Sydney-based free budget. So these are all different types of fintech businesses that I'm giving you, and all of them are bound by the regulations of that jurisdiction. So obviously in America, the SEC has different sandbox regulations than we would with ASIC here in Australia. So Pocketbook is a Sydney-based free budget planner and personal finance app. Again, it helps users set up and manage their budgets, track their spending, manage their bills. It's the first personal finance app in Australia to offer users the ability to manage money throughout linking all of their bank accounts across the different banks. So obviously there's going to be some privacy concerns there with you have to surrender some passwords and it's difficult to really give that up. But it really empowers those that need that help, that are happy to surrender their passwords and trust that third-party provider to do the right thing. That will really help them with managing their accounts and their finances more thoroughly. So fintech firms, as you can see just from the, small examples I gave you, they're often startup businesses that they use their novel business models to disrupt the incumbent financial system. And I gave you some examples in the payment space, but there are fintech businesses in so many other areas of the ecosystem in fintech. There's also in Australia a dedicated co-work space named Stone and Chalk, and they are a huge support to the startup community. And when they opened, they received 350 applications from different fintech businesses that needed a workspace, and they only could give out 150. It's just grown so quickly, and Stone and Chalk was the first fintech accelerator in Australia and one of very few in the entire world. Along with Hong Kong and Singapore, they've also created 3 fintech accelerators in less than a year. So it's moving very quickly. And many regulators in Asia have worked together to initiate a fintech strategy and work together with other countries regulating in a new era. And they also act as a network to help these small tech firms and say, oh, well, there's someone in Hong Kong doing something similar to what you're doing, and maybe you two could sort of chat or merge your functions and so forth. On a global scale, there are some initiatives to consolidate how this is regulated. There's what we call GFIN, and this is a new global initiative with over 20 countries that have signed up to a global sandbox product testing environment. So as you can see, I've just given you an overview of all the different types, but there is so much content to all of these. So looking at just going back, there's a fintech. There's an evolution of different fintech eras. So I've extracted some information for the purposes of this part of the presentation from an article entitled "The Evolution of FinTech: A New Post-Crisis Paradigm," and it's by Professors Douglas Arner and Juanos Barberis and Ross Buckley. And this article that I extracted this information from, it simply represents a high-level summary, and I really encourage further readings for more clarity in this area. If you're interested, put it in the readings. So the different types of fintech eras. So fintech's been referred to as a new term for an old relationship. And so there's the analog industry from 1866 to 1967. And it's argued that fintech, it's an inherently novel development for the financial services industry. Indeed, the introduction of the telegraph, the first commercial use in 1838, and the laying of the first transatlantic cable in 1866 by Atlantic Telegraph Company, that provided a fundamental infrastructure for the first major period of financial globalization in the late 19th century. And this period is usually seen as running from around 1870 with the laying of the transatlantic cable and other similar connections to the onset of the First World Wars. Subsequently, the introduction of the automatic teller machine, so ATMs, in 1967, we all know what ATMs are, by Barclays Bank. This arguably marks the commencement of the modern evolution of today's fintech. So the impact of ATM led Paul Volcker, who was the former chairman of the US Federal Reserve from 1979 to 1987, in commenting on the role of financial innovation in the global financial crisis of 2008, to famously saying in 2009, the most important financial innovation that I have seen in the past 20 years is the automatic teller machine. That really helps people and prevents visits to the bank and creates a real convenience. So I guess there was an understanding that not everyone can go to a bank. And especially nowadays, not everyone really wants to go to a bank. And you can see with, fintech products that people prefer to maneuver between all the different financial products and avoid going to a bank where necessary. And if you go into a branch nowadays, you'll see a lot of them are getting smaller, and it's changing to a more one-on-one consulting basis. The customer and the customer relationship is evolving with business functions, and as a result, the regulation and the laws behind how this is managed is also changing. But really, it starts with customers, business, and what they want. The second is the digital technology industry from 1967 to 2008. So the financial services industry it's been one of the prime purchasers of IT products and services globally. So you wouldn't think, but yes, the banking industry has been the biggest consumer of IT products, with a total spending of over US 197 billion in just as far back as 2014. So this is not a recent trend. It dates back to the mid-1990s when the financial services industry, it did become the single largest purchaser of IT products, and it still retains this position to this day. So for at least 20 years, the traditional financial services, they've been a driving force in the IT industry, and this trend has not been slowing. In fact, it's accelerated. So the financial services industry, it's predicted to double its IT spending, at least particularly as a result of this modern evolution of fintech. And since the late 1980s, finance has been an industry based upon transmission and manipulation of digital information. And the third era is from post, 2008 to now, and there have been some themes about democratizing digital financial services. So the fintech era has shown that financial services provision no longer solely rests with regulated financial institutions. There's been a mindset shift that has occurred from a retail customer perspective as to who has the resources and the legitimacy to provide financial services. Why is it just the bank? Why do the banks have all the power? Why do we have to prove all of these different things about ourselves to the bank? I mean, if you're a student and you're making money through all these different means and you've got the financial footprint but it's not recognised by the bank, then going to get a loan off a fintech business and they'll accept what money you've made doing all different types of non-traditional ways of making money. You might be an Uber driver, you might be building apps, you might be making money through other means. A fintech business might look at all of those and consolidate them and recognise them, whereas if you go to the traditional bank, they might not give you a loan for all these other ways of making money, and understandably there's a history behind that as well. But it really does sort of make you take a step back and think about access to the different types of people that would not otherwise have access to finances. When you think about maybe domestic violence and someone escaping a domestic violent relationship, they would need a different consideration in how you look at how they make money, obviously starting their lives and so forth. So whilst it's difficult to really identify how and where this trend started, it is possible to say that the 2008 global financial crisis represents a turning point, and it's really catalysed the growth of the fintech era. Post-2008 period, it contains an alignment of market conditions supported by the emergence of innovative market players in the financial services industry. Among these factors were the forever changing public perception of banks, trust, regulatory scrutiny, political demand, and the economic conditions. So each of these themes or these points are now explored within a narrative that illustrates how 2008 really acted as a turning point, and it really created a new group of actors applying technology to financial services. Looking at the fintech ecosystem, it really varies and there's so much to it, but just again as a high level introduction to the different literature and what different literatures say about this ecosystem. There's payments, deposits, market provisioning, investment within this ecosystem. And when you look at payments, it includes clearing and settlement, mobile, web and contactless payments, digital currencies, distributed ledger technology. Deposits includes lending and capital raising, marketplace lending, crowdfunding. There are fintech businesses in all of these. Market provisioning includes e-aggregators, smart contracts, big data, digital identity. And investment management includes robo-advice. I gave the example earlier about PEFN, electronic trading. So what are some other opportunities of fintech? So the information in this slide, it's been extracted from an article that I authored in the conversation, and it's entitled How the Open Banking API Could Transform Financial Services to Benefit Consumers. So fintech in Australia is is growing. It's rapidly growing both in Australia and also internationally. And according to a recent survey, Australian fintech companies have seen a 200% increase in median revenue since 2016. Open banking in Australia, which starts in July 2019, will lead to further innovation and growth in the industry. We may even see banks shifting into the backdrop as these businesses become the shop fronts of financial services. So we have entry points into WhatsApp, Facebook, Amazon, and now with Facebook looking at their own cryptocurrency and blockchain, they are the entry point. If you're going into Facebook and you're checking your friends' status updates, you might be buying things, selling things, and now you might even be able to get your own cryptocurrency, or in the future you might be able to get some financial products off there. So that's what open banking really provides, is that these APIs are almost like plugs into the different systems to put everything together and make the customer's experience more seamless in their relationship between finance and business and so forth. So banks could just be shifting into the backdrop, and these fintech businesses could become the shop fronts of financial services using customer data held by banks. Fintech firms, they are often startup businesses that use new business models to disrupt existing financial systems, and they create financial tools for everyday people, serious investors, and the banks themselves. Their customer focus caters to the growing millennial and Gen Z population. And these customers, they have large digital appetites. They have a technology preference, and they've always had a relationship with technology. An example is the Australian startup Zip Money. So they offer a cloud-based digital platform that allows retailers to offer a buy now, pay later service to customers for their products. In 2016, the company acquired Pocketbook, which syncs transaction data from bank accounts to help users track their spending and manage their money. Services like these aren't a replacement for traditional banking, but rather they just use your banking data to create new services to deliver better experiences for users. How will open banking work in this space? Well, it's going to force the four major banks to really make their data about their customers, cards, deposits and transaction accounts available to different services by the 1st of July 2019. Mortgage data will follow by the 1st of February 2020. So this data will only be made available, of course, to other services with the permission of the customers, and that permission can be revoked at any time. And so under this framework, fintechs will be able to access customer banking data using APIs. Now there's some which API, which ones are we using? Are we doing screen scraping? Are we doing open APIs? And are we going to align with what's happening all around the world? Of course, these questions are still being sorted with consultation. But at this point, APIs are looking to really transform the industry. And for those of you that are unsure about what an API is, it's an application program interface. It's like a universal power socket for the digital world, to put it really simply, allowing multiple systems to work together and to speak to each other. And they are meant to increase the speed and efficiency at which payments are made by giving fintechs easier and cleaner access to user accounts with real-time updates and the ability to process transactions. So PayPal, for example, they use a REST API. REST APIs, they enable merchants and developers to create applications that manage payments, payment pre-approvals and refunds. So open banking will allow businesses such as Amazon or WhatsApp in the future to offer financial services and products directly through their platforms rather than through banking sites. So this already happens in China via the social networking platform WeChat. Now, consumer data standards, this really all came about on the 26th of November 2017, where the Australian government announced that they were going to introduce a consumer data right in Australia, and this consumer data right will improve customers' ability to compare and switch between products and services. So really it's a service that's going to help customers make better choices and also encourage competition between service providers. Leading not only to better prices for customers, but also more innovative products and services. So the government determined that the customer data right will first apply to the banking sector, and then it will be followed by the energy sector, and telecommunications proposed to follow. So under an open banking, customers will be able to access and safely transfer their banking data to trusted parties. Open banking will be introduced in phases, with basic product information to be available again from the 1st of July. So consumer data for mortgage accounts, credit and debit cards, deposit and transaction accounts, they're going to be made available by the 1st of February 2020. And ACCC, our lead regulator, will be given a number of new roles in relation to the customer data right. We will be supported by the Office of the Australian Information Commissioner and the Data Standards Body as we develop the regulatory framework around it. And ACCC will work closely with these organisations to consult, but publicly and with other stakeholders who have an interest in the consumer data right, so fintech businesses. So just going back, so that's how it's all rolling out, that's how it's all changing. It's changing in the space of how do we manage data, how is this going to change our industry, who are these new fintech clients, everything is changing. But just going back to the more social justice aspect of all of this as well is financial inclusion. So I thought I would go back and say, well, what do we mean by financial inclusion? So for the purposes of this presentation, financial inclusion means the inadequate access to financial services, and this being a problem facing a significant proportion of the population across the world. So the nature of the challenges in this space, they vary significantly among developed countries and even between different groups of the population in the same country and region. Fintech companies are making significant progress in promoting financial inclusion through new business models and novel products. So in addition to these innovations, we see increased use of technological developments such as digital identity. We're even using, when you look at digital identity, there are even AI applications that can pick up edited photographs and accurately see that person has had their photograph edited. Biometrics, Internet of Things, artificial intelligence, machine learning. This is all believed to further financial inclusion, to build ways to help people get access to financial products. There is and the reason I brought this into this presentation is because there's a socio-economic justice in this, where fintech creates opportunities for financial inclusion, allowing many unbanked populations in places like India and Africa to have access to fintech mobile banking and lending. That doesn't mean that everyone has it or that it's been the solution. It means it's one of these things that have happened as a result of an innovation. So, you could be part of developing an innovative product or business that will then have a secondary benefit to something you may not have envisaged initially. But this is one of the things that is emerging, and obviously it's important to our university with a social justice focus. So just going back, the example of these fintech businesses that have contributed or assisted with, helping unbanked populations gain access to banking services is Paytm in India. Paytm's also in Canada. Alipay, over 520 million users, and also Complo, which is, a very interesting product. It's almost like a LinkedIn, but you're lending money to people, and so everyone will know if you defaulted on your payment. It's really a trust system, but another sort of less traditional way of lending money. Increased trust in technology use. There's also, there's an increased trust towards the use of financial services through technology. So mobile technologies. Millennials tend to millennial preference for this decentralization and equal distribution of power and opportunity is sort of gaining pace. And there was a 2015 survey entitled "Survey Shows Americans Trust Technology Firms More Than Banks and Retailers." And this reported that Americans are now their trust levels in technology firms in handling their finances is not only on the rise, but it exceeds their confidence that they have in comparison to banks. So the level of trust Americans have in, say, for example, Citibank, it's 37%, whilst the trust that they have in Amazon and Google is 71 and 64% respectively. So of course, Amazon and Google, they're massive, they're well-established corporations that have been around. Nonetheless, there is an increasing number of non-listed companies and young startups that are handling customers' money and financial data. So as I mentioned earlier, it's no secret that millennials tend to trust the digital world more than they trust their banks. And as a result of the Australian Banking Royal Commission, banks have really had their conduct and unethical business practices exposed, and there are now new waves of products offered by fintech, and they're likely to spur banks to really compete in a space where they've been really slow to innovate. So fintech creating financial inclusion. Fintech creates greater access to finances. However, much remains to be done. As of 2017, 1.7 billion people 16 years or older still do not have or did not have access to an account. Some 31% of the world's adult population. The World Bank's 2017 Global Findex database also shows that in the last 3 years, 515 million adults acquired a financial account, and between 2010 and 2017, 1.2 billion people opened an account with a formal financial institution or mobile financial services provider, including mobile money, for the first time. So the number of financially excluded are still disproportionately higher in developing and emerging market countries, but there has been substantial progress, as most of the 1.2 billion people who gained access to an account for the first time in the last 8 years live in developing countries and emerging markets. Particular progress has been made in East Africa, China and India. So the impact of fintech in, say, Kenya, East Africa, China and India has been very easy to detect and measure. Again, that doesn't mean that it's the solution, that doesn't mean that it's the only thing, but it just means that it's one of the more positive aspects contributing in that region. From 2010 to 2017, much of the progress was related to the impact of financial technology in a number of countries, and 3 examples stand out. So the first, development of mobile money, particularly in Kenya and East Africa, where this type of fintech has done the most to promote financial inclusion, allowing the unbanked to make payments, remit funds, save using their mobile phone. A lot of people don't have a branch around the corner. They live in, rural destinations where there is no access to banks, even if they could be at one. The second example is China, where a traditional and not overly efficient financial system became one of the world's most digitized financial systems. So this process was accompanied by the single greatest decrease in poverty in the world's history. And the third major example is India, where financial access increased dramatically in a very short time. And as of 2017, 80% of adults in India has an account, and this is the result of a major strategy to rebuild an ecosystem for a new digital economy and financial system. So an example is in India. They have India Stack, and in particular underlying infrastructure and enabling policy environment. Among other things, this has led to approximately 350 million people gaining access to accounts for the first time. However, beyond account access, India, like China, is experiencing a transformational reduction in extreme poverty to the extent that it no longer has the world's largest number of people living in extreme poverty. Impact of mobile money. Mobile money has played a major role in advancing financial inclusion, and the mobile phone is arguably the most powerful instrument of development in history. It originally developed in East Africa. Mobile money was usually led by telecom firms and focused on feature phones, relatively simple devices, limited in their potential application. As useful and important as mobile money is, fintech has far greater potential to promote financial inclusion through transformative digital financial services and economic development. While it's important, mobile money is only one aspect of building a broader ecosystem to support digital financial transformation. So despite these achievements, significant work is needed to assist the 1.7 billion people over 200 million businesses that remain financially excluded. Lastly, despite massive progress in China and India, these countries still have the largest unbanked population in the world in 2017. So there are still 225 million in China and 190 million in India. Increasingly, the unbanked are those who do not have access to a mobile phone, and this digital divide remains a major challenge. Some other challenges, like any fintech challenges, like any new and fast-moving industry, there are challenges. Some include the heightened operational risks. We have cybersecurity, consumer protection and data privacy issues, especially with the increased use of third parties working with banks. A lot of these are small tech startups. Do they really have an understanding of how data needs to be stored and ethical use of that? Are they in a position to do that? So concerns certainly in relation to trust in that space emerge. And lastly, the potential for financial exclusion. So the use of AI and machine learning in underwriting credit and insurance might lead to more accurate pricing and risk assessment, and they might even price customers out of the market. So that concludes the end of my introduction to FinTech, and I look forward to discussing more in this space and hope that you enjoy the readings prescribed. Thank you.